All right, guys, we're gonna get started here. Thanks everyone for making it today. So they asked us to put together just a deeper conversation about investing, and I wasn't quite sure which specific direction. So it's such an open-ended question. Is it single family? Is it commercial? On the buying side, the selling side, the long term, the short term. So I tried to put together just a really all-encompassing PowerPoint, and it's going to be pretty dense. But what I wanted to do is give the ability to share this with you for notes. So don't feel like you have to memorize everything on every slide. There's formulas, there's examples, there's breakdowns. All of this will be provided to you. Shoot me an email, or we'll probably just shoot it out to everybody. And it'll give them all this sort of information to help them as they work with investors. So what we're going to go over is just talk about Misty and I and our investing experience, the 4 pillars of real estate that I use to help the consumer understand the power of owning real estate, the investing terminology, so that when you're working with investors, you're speaking their language. One of the most important things I noticed was if a realtor can't speak investor, the investor finds another realtor. And there's a lot of realtors that think that investors are a waste of money or a waste of time. And it's until you provide the right value that it meshes. Because once you do that, it is just a constant repeat of business. So a really important concept is cash on cash versus cap rate. I broke out examples showing each one of those, just the full impact of owning real estate. I want to touch on the BRRRR method. This is how you get infinite returns in real estate, and how you see all those young kids that are like, I own 50 properties. You know, like, how did you afford one? We'll talk about that a little bit. I want to talk about investment finance, the commercial side, the Fannie Mae, Freddie Mac side, advanced debt strategies, and then some depreciation information. So a lot to go over today. First, a little bit about me. I started investing in real estate. I think I was 22, could have been 23 when I flipped my first house. I put about $30,000 in education, traveling the country, going to seminar, coaches, events. So far, we flipped about 50 houses. That was our primary focus. I say we because I just like to build systems. It's Hannah. Hannah does the majority of the work on all of that, so the credit really should go to my wife. First it said I, and then I was like, if I put I in here, I'll be sleeping on the couch. It's definitely a we. So over the past 3 years, we've averaged 22 houses a month. So it's just a system that we built. Marketing goes out, crew goes out, and it just has us flow. Currently, we own 26 properties, units, how we perform our doors. We have 14 under contract right now.
I am fairly new to the investing world. We sat during COVID sitting at home and realized on a pay stub how much money I'd made in that market, and was like, gosh, where did I spend it all? And my husband lovingly sent me to the garage where we had a nice big stack, a wall-sized stack of broken down Amazon box art. And so I was like, oh, I need to do something better with my money. So we decided to buy an investment property. And so that's how it started. And so 2 years ago, now we are up to 9 properties. 4 of them we Airbnb out. I own one in Texas, I own one in Florida, and the rest of them are kind of valley properties that, you know, just normal everyday rentals.
Someone else is taking over.
Oh, got it. Okay.
Do their thing.
I always say I know enough to be dangerous, but I'm having a lot of fun. So my goal is to have 10 properties hopefully by the end of this year or next. And once I hit 10 properties, my goal is to work on getting them all paid off, because when I hit 60, I'm going to be every other month here, Florida, here, Florida, here, Florida is my master plan. It'll all be paid off. That will be cash flow for me. And I will live in each investment property in Valley for 2 years, and then I'll sell it tax-free.
Nice.
That's all I know.
2 years, important concept.
Yeah.
So our first home we lived in 2 years in 1 day.
Yep.
Just so there couldn't be any confusion. I'll just let Lisa do her thing. I really don't.
Lisa.
Okay. There we go. So when I talk to clients about real estate, everyone gets stuck on the cash flow component, and they say, oh, well, this property is going to make me $200 a month. Who cares? Why would I take on this risk? Why would I do all this work? Why would I have nights away from my family for $200 a month cash flow? And that's the income generation piece. And when people start thinking about real estate investing, that's where their mind goes. But as you start to unwind all the elements and the benefits of real estate, it's actually the least impactful. It's the least important. You start to really put all the pieces together. So you have the income generation. That's what you're going to make from a cash perspective. We're going to talk about how to analyze that. Most importantly, in my opinion, is appreciation. The biggest thing that people may not realize is if I put $50,000 in the stock market, I'm going to get appreciation on $50,000. If I put $50,000 into real estate, I get the appreciation on however much real estate that buys me. So if it's 10% down, that's a $500,000 property. So I'm getting appreciation of a $500,000 asset. If it's 25% down, it's a $200,000 property. I'm getting the appreciation on that asset. So when you just look at that, buying a $50,000 in the stock market, 8% returns, $4,000. $200,000 house, $50,000 down, 4% return is, it's $4,000 to $8,000. So you're getting double the return on just buying a rental from an appreciation standpoint. Now, if you take that and look at, well, what if it's a secondary home at 10% down? Or what if it's, a much larger purchase, a $750,000 purchase at 5% down? These things all stay true. So your ability to just exponentially get more appreciation from real estate than any other asset class is huge. Another thing that seems obvious, but principal reduction. Every year you own that property, there's a wedge. That property is increasing in value and your debt is going down, and what is in between is your net worth. Lastly, which I think is more important than even principal reduction, is tax efficiency. Everyone talks about losses and rental income being write-offs, but what we're going to talk about is called accelerated depreciation. For me, as soon as I became a lender, I switched over to W-2 and had to start paying taxes, and I hated it because I came from a realtor and that really wasn't the thing. There was always a way to get the deductions and write it off and do this and do that, but once you switch over to W-2, it gets much more difficult. And we as realtors or our really affluent clients have the ability to take advantage of something called accelerated depreciation and accelerate the depreciation from their properties from 27 years down to 1, and then write all that off in 1 year. So you can take an enormous deduction, and then if you gain income through the sales of real estate in the eyes of the IRS, it goes from a passive loss to an active loss, which means it can roll over onto your personal return. And so if you set up these steps correctly, you're no longer paying taxes on your W-2 income. I'm tax exempt for the next year and a half. I won't pay taxes and I've got all the back. So it's just understanding how to set up these systems to really be able to benefit you. So before we can deep dive into how to put these formulas together, what is important to know, I just want to start with some basic terms so that when you're talking to investors, you're speaking the right language. So first and foremost, revenue. I know it seems simple, but what I'll hear a lot of people say is gross revenue, and then it's just a redundancy. And so if you're talking to an investor, they just know that you may not have the depth of knowledge they might be looking for. So revenue is gross income. So gross revenue is a so it's just your gross. So what you're really looking at is revenue against NOI, which is net operating income, and that's after your OPEX. So we're going to talk a little bit about the difference between OPEX and CAPEX, because when we start looking into cash on cash returns and cap rates, it starts to become a factor. So net operating expense is taking into account OPEX. So what that is if you own the property, you're paying taxes, you're paying homeowners insurance, you have a property manager, you might have management software, all of that are your operating expenses. Those are different than I had to put $10,000 into the property to redo the kitchen, or I had to put $20,000 down to buy it. Those are called capital expenditures. And so when you start to look at how you analyze these deals, it's important to understand what costs belong on which lines. A couple more terms I think are really important are T12. So this is going to come more into play if you're looking at apartments, multifamily, trailer parks, commercial, anything along that nature. It is just a rolling 12-month P&L. A lot of times people say, oh, well, here's the pro forma. A pro forma is what it could be. We're currently buying a trailer park, and their pro forma was $7,500 a month. And I spent a month asking for the T12. Give me your T12. Give me your T12. We finally get it. He didn't have one. Instead, he gave me every in and out of the bank account for the past 12 months. And I had to go through and sort. Actual income was $4,500 a month. So it paints a drastically different picture from his pro forma to the actual T12. So if you're working with investors, this is just the number one thing you're looking for. LOI, I'm sure you guys are more familiar with that. When you move into the commercial space, a lot of times you're getting attorneys involved in these contracts. It's not a 10-page boilerplate contract. It's a living, breathing thing. And so instead of getting attorneys involved up front prematurely, you go through an LOI phase where you just write down your intentions in detail on a piece of paper and then negotiate back and forth with the LOI. Once all terms are agreed upon, then you pull in an attorney to start putting things in line. Sales approach and income approach. This seems like a no-brainer, but I see people get burned by this all the time. When you're looking at real estate investing, so much of what you're doing is looking at an asset now and what that asset can be. What is it worth today? And what can I drive that value to? And if it's less than 4 doors, it will always be the sales approach. So if you buy a fourplex and make triple the amount of money, and you're thinking this is going to triple my value, but the nice fourplexes down the street don't have that income, but are nice, you're going to hit their value. You're not going to hit what that income would provide you from the cap rate or from an income approach, because if it's under 4, it's going to go sales approach in the appraisal. That's what makes 5+ in commercial so interesting, is now it no longer matters what's around you. It no longer matters the properties that surround you. It matters how much income can I drive through this property. And that's how you can really start manipulating the values. And it comes from 2 sides, because we're talking about net income. It's how low can I get the expenses as much as it is how high can I get the income. And I'm going to show you a couple examples just to show you how easy it is to a $10,000 change in net operating income and what that actually means to the prices of these properties, just so you can visualize it. But we'll get to that in just a sec. And I had a bunch of cute animations. I went to save this and the whole thing crashed and I restarted. So I've done this twice to get here. So a really important concept is you buy the cash and you sell the cap. And what I mean by that is when you're buying investment properties, you want to look at the formula that's cash on cash, because cash on cash takes into account your specific financing terms, your interest rate, your homeowner insurance, your down payment. Cap rate doesn't do that. Cap rate is how you sell properties. Cash on cash is how you buy them. So what cash on cash does is it looks at what your money is returning compared to what it would do in the stock market. If I put $20,000 into real estate and make $3,000 a year, how does that compare to if I put $20,000 in the stock market at an 8% appreciation rate? You have to have a way to make these things apples to apples so you can understand the value of your money and your investment. That's what cash on cash does for us. So the formula is a little bit more complicated than cap rate, but once you get it down, it's really, really simple. So essentially, we start with the revenue and we're trying to get to your NOI. Technically not. That's why it doesn't say NOI. So first you would take the revenue minus those operating expenses and then your own debt service. Take that and divide it by your cash to acquire, which is your CapEx, which is going to be your down payment and any closing costs that you have. I'll show you a formula that breaks it down so it's not just a bunch of words, but typically what you're looking for in real estate investing is 7 to 11%. That used to be a thing when I got started, everything was 10% or better. It was great. Everywhere I looked, every property was 10%. Now when people are like, oh, I will only buy if it's 10%, I'm like, good luck, because you're just going to really struggle, especially in Omaha, Nebraska. It's not just rates and prices. It's these property taxes. These property taxes are crushing because that all goes into this OpEx number. There's no benefit to paying more property taxes to an investor. It's just more expense. Now on the flip side, you have cap. So cap rates is your capitalization rate. This is how you sell real estate. So where cash on cash creates a apples to apples comparison for me to compare the value of my investment, cap rate creates a language that I can share it with anyone and we have the same number because I don't know their financing terms. I don't know if they're cash. I don't know what their homeowner's insurance is. I don't know any of that. So I can't give them a cash on cash number. I can't give them that type of information because it would be specific to each investor. So this is what you sell on a cap rate, which is a much simpler equation. It's just the net operating expense divided by price equals your cap rate. And we'll break that down in a second. This is the most powerful concept to anyone that's looking to or flip apartments or be able to buy things on a much larger scale and be able to pull their money out of them, is understanding the impact of your cap rate and how you're able to manipulate it. And I'll give you a couple examples here in just a moment. But what you'll find is with cap rate, lower is actually better. Where cash on cash, higher percentage means I'm making more money on my money. On your cap rate, the lower the percentage, the higher quality asset you're getting credit for. So if it's a $1 million building at a 4 cap and someone's buying it, that building has a $40,000 a year NOI and someone's still willing to buy it for $1 million. If it has an 8 cap, it needs an $80,000 NOI for someone to be willing to buy it at $1 million. So it's a completely different calculation, and we'll go through a couple of it. And like I said, I'm going to give you guys all this just because the difference between cap and cash on cash is so important to separate. So we'll just start with a basic home. You're buying a $250,000 house, you're putting 25% down. Right now, you're looking at about $10,000 in closing costs. If it goes secondary market with us, there's going to be a point to 2 points. It's just the market we're in, taxes, insurance, appraisal, all that good stuff. We're going to say it's 10K to close on the house. Brings in $2,400 a month. There's a reason I separated out the payments because it will matter. Principal and interest, vacancy and maintenance. A good rule of thumb is 5% for each, and that's probably aggressive. I worry less about my cash on cash than I do the whole picture. So I'm probably a little bit more aggressive on vacancy and maintenance. Alex, I think we were talking.
Yeah.
And you were like 10 for this, 10 for that.
But we run our very conservative, so I can, yeah.
What do you run?
I think we do roughly about, I want to say 9%
For
per vacancies, or like instead of
5.
Yeah.
And you do maintenance on top of that.
Yep, maintenance is also I think 10% as well.
Another 10. So just an example, like when this is why it's so important. I run my numbers. I'm at a combined 10% between your maintenance expense and vacancy expense. He's at 19. So if we're looking at the same property, we're going to have 2 different valuations on what it's worth to us. And this is why a seller can't sell in cash on cash, because they would have to be trying to protect those specific buying criteria that they can't. Where on a cap rate, it removes that type of individual opinion out of the formula. So just the basic information on the house. If you look at cash on cash, first, we're going to go back to taking the revenue. So what's our gross rent? Cash on cash takes into account your debt servicing. So here's your PITI, principal, interest, taxes, and insurance. It's also going to take into account that vacancy and maintenance expense. Like I said, we do a combination of 10, Alex has a combination of 19. It's person to person. So that's going to give you just your NOI, that net cash flow. Annualize that, take it over a year, and this is how much money that property is making. But it doesn't matter how much it's making, it matters how much it's making in relation to how much it costs you to make it. Does that make sense? So how much money did it cost us to make it? You have your entire down payment and the closing costs. That goes back to that CapEx term from the other page. That's your capital expenditures. So your total cost to acquire. If you're in a position where you needed new bathrooms, new kitchens, anything like that, it would also be accounted for in this number because you want your total cost of buying that asset and getting it up and running factored into your cash on cash return. So when it's all said and done, you'd be looking at a 7.2%. And you'll see a lot of investors that are struggling right now because I don't think I can buy something for $250 and rent it for $2,400 a month. I don't think you can. I'll buy it, right? When I was originally doing this, I was trying to compare market rent to what I was seeing for price. This was more like 2,100. It dropped, if that, and I was kind of being a little aggressive there, and it dropped it to a 4% return. And I was like, well, I can't come up here and tell people why not to buy rentals. So I was like, well, if you could find one in 24,
Start selling the long game.
sure. So well, that's what we're gonna get to because when we talk about those other pillars of real estate, that long game makes this number irrelevant, and we'll get to that in just a second. But yeah, you're so right. Whereas if you were to look at the cap rate on it, which as a reminder, cap rate's going to be more impactful on bigger deals, commercial, multifamily. It doesn't really apply any value in single family. So you never see it advertised on the MLS. This is being sold at a cap rate, or rarely. I typically don't see people go that far. But the big difference that I wanted to point out is you still have the taxes and insurance, you still have the vacancy and maintenance, but you don't have the debt service because that debt service is going to be independent to the cash on cash calculation the buyer makes. So you remove that from the cap rate. We'll do the same thing. We'll annualize it out and then we'll divide it by the price. So it's two completely different numbers. You know, the cash on the property was 7.2. That's how the buyer is going to be looking at it. The cap rate from the seller was 8.4. That is the value he's selling the property at. So they're just two very different things. I like to explain cap rate in a little bit more detail because fundamentally this is how you move the world. If you buy a building for 700, it can double the rents. What's it worth now? And then what can you do with the value you created? So this is where that NOI and that cap rate, why we got so term specific, really start to come into play. So if this property has a net operating income of $60,000, I would divide that by the price. It tells me it's a 6% cap rate. So that's an average purchase, I would say, in this market, probably anywhere from a B quality building. A's might be lower, but anymore, that's a pretty standard rate. But what happens if I buy that building? I'm still willing to sell it at a 6 cap, but I'm able to raise the NOI by 10 grand. And that's not a very big number. That's $10,000 more a year of income. So if I raise every rent by $100 and there's 10 of them, there's $12,000. If I'm able to shave out any sort of operating expenses to get there, now the formula looks a little bit different. I'm going to take the net operating income and divide it by the percentage of the cap rate I'm shooting for. So if I think a bank will refinance this property at a 6% cap rate, I would take $70,000 divided by 6%, and it's going to give me that value of what, and if I could pull this off and a bank agreed 6% was an acceptable cap rate, that's now the value of the building. So you added $160,000 of value by raising the net income by $10,000 a year. But on the flip side, what if the bank wouldn't give you a 7% or a 6% cap, or the buyer that's buying the building won't buy it at a 6% cap, but will buy it at a 7% cap? Your NOI stays the same. And now we're just going to divide that by 7%, and it's going to spin out the final number. And so now the difference between buying a 6 cap and a 7 cap is $150,000 the other direction. So just understanding the relation between these numbers, I think is the most powerful piece of it, because once you have that piece down, your ability to advise, your ability to understand and look at a deal to see where the future can go, I think is exponentially better. So I like to talk about this because him and I were talking about how he uses a 19% vacancy and maintenance. I use a 10. So with me using a more aggressive vacancy and maintenance, I'm going to have a higher cash on cash return in my projections than Alex would have in his. But why, to me, I try not to get caught up in the nitty gritty of that. And Alex, the conversation we were having yesterday is when we talked about those 4 pillars of real estate, between the income generation, the appreciation, the depreciation, and that tax efficiency component of it. When you start to break that down, this is that same $250,000 house from that earlier example. You know, if we're getting a 4% appreciation rate, that's 10% a year. And no, that's not $10,000 that's hitting your pocket every single year. You're not, you know, that you're not paying taxes on it. It's not technically income, but it's growth in your net worth. And if you're on a 30-year mortgage and it's amortization schedules make it complicated, it depends how long you own it. Is it a 20? Is it a 25? How are you going to set up? You guys know all that. But if you can assume there is some level of debt reduction, let's take a 30-year loan and divide it out, right? 3% a year. That's $7,500 of principal reduction a year. So when I sell or when I get excited and talk to people about real estate investing, especially if they have any sort of affluency or any sort of strong W-2 income, I'm never going to get someone to buy a house that's making $200,000 a year by saying, I can make you $5,000 more a year. Take on all this risk, spend your weekend with this property, and for you, $5K a year. It doesn't move the needle enough, I think, to get people motivated. When they start to look at the whole picture and realize that it's actually that $72,500 investment from that original cash on cash equation we did. If you were to put like, what is the return to my net worth of doing this between the cash on cash, the appreciation, the debt reduction, it's now 31%. And this is why I don't get really caught up in the weeds on whether this is a 7 or a 4 up here in the cash on cash, because either way I'm getting those 2 things. And this is a far greater return. This is 24% to 7%. So if this drops down 2 percentage points because I use a different valuation, I still want the deal at a 29% return on my money annually. So when I start to have people think about real estate in these type of metrics, it completely changes the game. Conversation of is the interest rate 7 or 7.5 is gone. Conversation of what is your fee to list it is gone. All of those things disappear when you can show someone how all these things come together. So that leads us to one of the points we started talking about is BRRing, which is how you see these young kids with 50 properties and you look around and go, how do they do it? It comes down to understanding those formulas and how to be able to manipulate those values like we talked about on the cap rate page. So essentially BRRR is a nice, it's not mine. Have you heard of Bigger Pockets? This has been around a very long time. But essentially you buy the property, you renovate the property, you rent the property, you refinance at its new value, and it gives you the ability to repeat. So why they call it infinite returns is if there is a $200,000 property and I were able to buy it distressed for $100,000, fix it up for $50,000, be all into the deal, $150,000, and the bank were to refinance that based on that $200,000 value, I would get all of my money out of that transaction. And so that is how people are able to rinse and repeat and grow their rental portfolios. Of course.
That's exactly how I bought all 8 of my 9 properties in 2 years.
Yeah.
It's from doing that. We bought slightly dilapidated properties, 2 bedrooms, 1 bath, fixed them up, made them nice. Sometimes added a 3rd bedroom, sometimes added a garage, but then there was always enough equity left for me to buy the next one.
Yeah, and that's it's how I think most investors do it, and there's always the risk, especially if banks are allowing people to go to 90% or 80% or using bad valuations, or you're not fixing things as you go. They call it a CapEx tsunami. So if I just burn through a lot of properties and don't do sustainable quality work, well, I own all those, and at some point those chickens come to roost. So where people do get in trouble with BRRR, just because I don't want to say, hey, everything's bright and shiny, this is the gold ticket, is they either can't support the influx of cash. You have 10 properties and 5 of them to take it. Now you're losing thousands and thousands of dollars a month. The buyer needs to be prepared and capable of handling that. And on the flip side, furnaces start going out left and right, and you're shelling out $30,000, $40,000, $50,000 in a year of furnaces. My little calculations on paper did not qualify for that. That wasn't in there, right? 50K in furnaces is much different than 5% of your payments. So just things to look out for if you're helping people BRRRR or you're looking at buying into real estate is don't put yourself in a position to where you have so much future maintenance and upkeep that you need to be aware. Roofs don't last forever, furnaces don't last forever, and they're big ticket items that insurance doesn't cover. You can avoid those two things. I think real estate buying in Omaha, Nebraska is a pretty safe bet. That it's going to continue to go one direction. So we've covered a lot so far today, guys. I know this has been a lot of information, but I want to detail out the difference in financing options because I work with a lot of clients, I work with a lot of investors, and I'm not always the right fit. Even yesterday, I got a lead. It's a $800,000 purchase, max conventional loan, 720. As a lender, I should be like licking my chops. Like, this is as good as it gets. He sends me 17 K1s and 6 other tax returns. It is a mountain of paperwork. He already been denied by one bank, right? And I'm looking through and actually think we can do it. We specialize in self-employed. We do a lot of it because I've been self-employed. We know what we're looking for. We find income others don't. But I'm not sure I'm going to be his best fit. I know a lender, he's buying in Overland Park because we're looking at buying there. I got them in contact at the same time. So I'm working the file and I have a commercial lender working the file at the identical time. So we just want to find the best option for them. Sometimes I'm it, sometimes Misty's it, we are it, sometimes we're not. But what we're going to do if we're not it is make sure your clients have those right connections and are put in place the right people. That's why I'm not just going to talk about the benefits of what we do, but also what benefits are on the other side of the fence. Because if you're really trying to help a commercial or an investor build his portfolio, he needs to understand and be able to use both of these channels to be able to really hit his goals or their goals. So biggest thing you need to know is Fannie Mae, Freddie Mac, that's us, mortgages, secondary market. That's what we do. So you're going to be able to get on a 30-year fixed rate. So it should help you improve that cash flow. Typically, you're going to have lower interest rates as well. Costs are higher right now with points, but the interest rates are lower. I find Fannie Mae, Freddie Mac to be more friendly to a new investor, especially if they have W-2 income, any sort of stable employment. We can make it a much smoother approval process with a lot higher success rate because commercial banks are betting their own money. And so they look at that person, they say they've never owned a flip before, or they never owned a rental. They've never flipped a house before. They have no track record in what they're doing. We don't want to place that bet. So a lot of times people start off secondary market and then we'll transition into that commercial side of things. Something special that we do is those HELOCs on investment properties that fund in 10 days or less. And that's a really huge value to anyone that's bought real estate over the past couple of years. We're up 30% since the beginning of COVID. They had 3-4% interest rates. Now they're 7.5%. If we can give those people 30, 40, 50, 60 grand to go buy the next one without having to remove that great rate that they have, I think it's a huge value. Just so you're aware, HELOCs can be used for down payments. So they absolutely can take that money and use it to buy the next property. We also have something called debt service coverage ratio loans, which means we no longer are really looking at the strength of the buyer from an income standpoint. We're just betting on the property. We look at the property strength. So if you have that person with like really complicated tax returns, doesn't look great on paper, has the money to put down, has good credit, we have solutions called debt service coverage ratio. The biggest place where I've seen people get stuck is actually right here. Must wait 6 months to refinance based on new value. So I've had a lot of people come to me after buying a house with 20% interest, hard money from a local hard money lender, flipping the house in 2 months and trying to refinance out of it. We can do that refinance, but the secondary market cannot go off the new value. So we would have to go off that old value, which helps them not, because they have that purchase, they have all the money they put into it, and we'll give them back half of what's gone in. So they have to hit that 6-month requirement before we can do it. And so like I said, I know this is a lot of just dense information we've gone through. I'm going to share this PowerPoint out so you guys have the formulas, have the bullet points, everything like that. So on the commercial banking side, things really start to open up. It's gonna be a good fit for your more experienced investor. They have some properties, they have some other self-employment income. They're more maybe affluent, more versed in that space. It really starts to open up options. One misconception I hear all the time is people ask me, Neil, you can buy a single family with a commercial loan? Absolutely. So people hear commercial and they think restaurant, car wash, you know, you name it, but single family, you can absolutely do it. It will be more experienced or friendly to the experienced investor because I can only go off of and Misty can only go off of what they pay taxes on from income. So you can have a guy making $2 million a year, losing $200,000 a year. To me, he can't buy a shack, right? You go to a commercial bank and they're allowed to see through that and say, hey, this guy isn't losing money every year. He's an efficient businessman. Okay, he has the track record. He knows what he's doing. And so you can get success there where you may not be able to find it. Also, you'll be able to find great term flexibility. We just had a woman die in a house that we own. And I called my bank and I was like, hey, this kind of sucks. She died. And he goes, oh, do you just want all the money you need to fix it up? Yeah, I do. That's what I want. Do you just want to not make payments for 6 months? We'll kick them on the back and you can flip it and get rid of it. And I was like, yeah, Eric, that sounds great. Let's do that.
What I hear you saying is.
And so when you build those, yeah.
Buy a shovel.
Right. God forbid, right? But when you have those great relationships, the level of flexibility we can't do in the secondary market because we have to hit that federally regulated Fannie Mae, Freddie Mac guideline. It doesn't matter if they've done 20 with us or 1. There is no flexibility in that. Where on the commercial side, there will be.
What are interest rates currently on HELOCs?
You're probably looking between 9 and 11
And your payments due 30 days after
after it's started. Yeah. But then for like retrospect, commercials like 8.5 right now. And then secondary market's like 7.5. So like
With charter.
good. Yeah. So that's which sounds crazy to be like 8% is good, but
Right.
you know, compared to where we were, I feel like
But depending upon what you use it for.
right. That's really what matters if it's good or not. So and
I have a
also,
question.
Yes.
If I wanted to buy an investment property, is it smarter to start out and like pay cash for something or finance something
I think, and that's hard
like
to
right now?
yeah, because like it depends on strategy. For me, I don't want to because I can own one house 100%, or I can own 4 houses 25% ownership per house. And then I look at it as what yields the greater cash flow and greater appreciation, write-offs and depreciation. So if you look at like strictly what returns better on paper, it's going to be to have the leverage, in my opinion. I mean, you're going to get a much greater, you get 4 times of everything, right? That being said, you're taking on more risk, you're taking on more debt, you're taking on more responsibility. So I think for the average investor, they should probably start with 1 rental. If I had, if I was buying a $200,000 house and a $200,000 cash, I would probably, or $200,000 cash, I'd probably spend $50,000, buy the house and keep my cash.
My other question is, how do I decide if I want to start with like a small commercial property where I don't have to mess with quite as much, or residential?
Like a small commercial property. What do you do?
Yeah.
Buying a restaurant, that's a headache in it.
Yeah, I don't want to buy a
Or
restaurant.
buying a-
No, like a rental building, a building that I would be
Before
rented out. No, as far as like commercial, like strip mall.
Oh.
Yeah, I mean, I think being a realtor, I would think the commercial property is the way to go. Would be my take. I mean, you get someone on a triple net lease, which
Right.
means they're paying for essentially everything. And you don't really have to worry about the maintenance, anything.
Build out
So
all
the
the-
build out, that's all on them. And so if you have the cash set aside, I would consider that. That being said, commercial space is in almost a more turbulent place than residential, because it's not just, is this business a use that will continue to be needed at this level? It's also, are businesses still needing this space like they were? There's just more to consider in commercial right now. But there's obviously things that are staples. If you're like, Neil, should I buy a strip mall on 144th and Maple? The answer is yes, regardless of what's happening to or not to office space.
I think the code onto that is if you're buying a commercial building with already occupants, that's the leasing with a good tenant of either is something that if you're buying something that you're thinking, oh, this would be a great place for, you know, counselors to come and set up a shop or something. You're like, these guys are all working Zoom. So like, I think it just depends on, there's pros and cons to both. We have friends that own commercial and during the pandemic, she still has one unit that is still not rented. She's like, it's great, we're making money again, but like during COVID, she's like, we were dipping into our savings because like they were just, I mean, they just checked out. So
It's all about the tenant. Raquel's right. It's all about the tenant.
Great answer.
Quality of the tenant, duration of the lease,
I mean, we have a
bumps in the lease.
Yeah.
You know, I mean, Walgreens still there. You could still, Walgreens does lease backs. They're probably still doing them. They were 4% at one point cap rates. They're probably at 5.5 now, 5.25. Why do people do it? Because Walgreens is going to pay forever. So it just kind of depends on them. I would not, I mean, office is gonna be tough right now. If somebody said, you know, oh, here's an office building that could have an anticipated NOI of 50% more. But you got 100,000 square feet of space to fill, I'm probably a no on that. But if I've got a national tenant that's signed a 20-year lease and we've got 2% bumps, I might take if I can cash flow it, I might take a 5.5% cap rate.
I think it just comes down to the numbers, like Tom said, and we have a property right now that we love the tenants, but when they move, I want to dump that thing faster than, I don't want to deal with the new type of tenant that live over there. But the tenants we have now are amazing, and they're gonna be there hopefully forever, so. But yeah, if you have a great tenant and the numbers work on paper, that's the key thing, if the numbers work, doesn't matter.
Thanks.
I think single family is easier to digest.
Yeah.
So when people come to me and they're like, hey, this is all completely new to me. I would probably have that conversation, but being a real estate professional, the resources you have, it really comes down to finding the right deal, the right tenant. It could go.
Can I add to that too, you asked if you should cash or finance it. I personally think too many times investors think that if they buy it cash, they got like a better deal because they're not paying, you know, P&I. But again, if it works in the numbers, why would you put, if you have $250,000 saved up, why would you put it all into one property? Let the bank's money work for you, and then you still have cash for it. And I don't think that a lot of investors sit down and say, hey, that air conditioning is 18 years old. There's a good chance that I'm putting a one in and that furnace is over. And they're tapped out when things go wrong. Then they're freaking out, calling you, and I need a HELOC, and I need to put, you know, all this money in. So I think it's like if you use somebody else's money and factor that into your figures, you're going to be able to be more successful than buy got it in the bank. That's stupid. That's like putting it in your mattress.
What do you think, either one of you could answer this, cash versus financing on purchasing flips? Other than the advantage from the offer.
I've never found that it gives me an enormous disadvantage because like we're underwritten one time a year and I send all my financials and we're good. And so like I can say, hey, I can close in 10 days as good as cash.
Yeah.
So, okay.
So it's cash to you.
To me,
because
it's
you have that
cash.
relationship.
Like I'm saying yes. You know what I mean?
Yeah.
And so if you're in that position, I don't think like it's never truly hurt us. I would think from like a purchasing standpoint. And then that's a much more interesting conversation because I like to say, and I've been burned. So debt's like fire, right? It separates it separates the man from the monkey, but it'll also burn down your house, you know? And so you start flipping, well, hey, if I can flip one house cash or I can flip 4 houses at once and those are adjustable rates that were 4 and now they're 9, you know what I mean? Now your monthly carrying cost on this venture just got enormously higher. And so I see more flippers and builders get burned than I see long-term renters or like long-term holders when it comes to should I use cash or leverage, because those holding costs can get very extreme very quickly and projects never get done when you think they are. And now in this market, they're sitting. And so I if you want my opinion, if you were starting off on flipping, regardless of my cash position, I would start with 1 and then, the more cash heavy you can be and keep in your pocket while going through that venture, the better off you are.
Don't you think that's the way we can get people into this is to start, they're not thinking for when they're starting, they're not thinking for, so, yeah.
I think a lot of it too is you've got to have processes and systems in place, whether you're one person or you're a family or, you know, you're working with 80 of your buddies and 100 properties. There have to be processes and systems in place, whether that's something like I'm using, you know, tenant data or apartments.com or whatever it is to collect your rents. Or if you're doing short-term rental, do you have, you know, guesty or whatever, or are you doing this yourself? Are you, God forbid, going over and cleaning every time somebody moves out? If you're doing that, just stop. Like, you're gonna kill yourself. But I mean, I do think a lot of people look and they're, oh, I'm gonna flip houses because I know how to use a nailing gun. Well, that's great. But if you hold it for too long, to me, that's expenses that there's nothing you can do about it. And it's just, you might as well just give the bank more money.
Yeah, that's what you're doing.
We have to have a team in place. You have a team in place of people that like, boom, you have your husband and team and like people, that's one thing we have to talk to people about. It's like, yeah, it sounds like a really great idea, but
yeah, you say, okay,
how long did it take for you to get an HVAC guy out there? Yeah.
And it's gonna take them 6 months, the first one, because there's gonna be so many mistakes, reworks, we're lucky.
I just had clients of mine, had a huge deal go, they were putting an RV in over in Iowa. And the whole deal fell apart at the 11th hour. I mean, everything's ready to go. Website's ready to go. All the marketing's ready to go. She goes, all I need to do is tell them to print. Everything's ready to go. The electrical came back 3 to 5 years because of parts. It's a supply chain issue. And the bank was like, yeah. I mean, nobody can hold it for 3 years. She's like, we can't own this land and not do anything with it for 3 years.
We bought a 6-plex and then I closed on it and they said, hey, that electrical part needs to fall us out. You're stuck.
Yeah.
You can't finish it. You can't do anything. You can't drywall it. You got to sit here and wait a year at 8% interest on this until the part comes. So it's very real.
Electrical parts, luckily it had fuses, so we didn't have to wait, but yes, we just picked up electrical parts and we got it where it's the MI or whatever. Looked at my husband, he goes, I would put these in your car and I would drive away very quickly.
Don't look back.
I mean, it is, but that's the stuff that you have to factor in and you have to realize if I can't get that done, especially on a flip, it could hold the whole thing up.
And the best decision we made there is we have a very strict buy box. And every time I get brave and go outside of it, I get burned and remember why I have such a strict buy box. But we only yeah, we do. It's like,
I knew that was coming.
to your point.
Don't do it.
Don't do it every time.
You do, but that's it comes down to, you know your systems.
Mhm.
You know what it takes, you know what I need to do, you know who's gonna do what, you have backups.
But the best advice I think you could give someone if they were going to enter this venture is start cosmetic. Yeah. Like if we have to rewire it, replumb it, reframe walls, do all these things to make it a good deal, we buy it, put it back on the market to sell it to someone else. Because I know what it's gonna take me to get that done and how much money I'm gonna lose along the way, and we can flip 2 or 3 cosmetic flips in the time I can do that one. So like we've decided we do cosmetic and we can do them in about 6 weeks. And just churn them out. And anytime it's outside of that buy box, we just sell it to somebody else. And so I see too many people get into it, like, oh, I gotta take this thing down to studs, rewire, and they don't know the permits. And then now they don't have a general contractor. They're starting on their back foot. Anyways, that's a whole nother conversation. But if you can get them to start off cosmetic, they're in such a better opportunity to succeed than if they buy that thing that has to be completely rebuilt.
It's called buying grandma's house.
That's it. Yeah.
The grandma house provision.
Just to finish this up, when you start talking to people that are thinking about going to commercial, you're gonna hear this all the time. 520. This loan is a 520. What is a 520? So it's a 5-year balloon. So the loan only exists for 5 years, but it has a 20-year amortization schedule. So even though the loan will be there for 5 years, you're making payments as if it's a 20-year loan. That's going to be, my opinion, your most common commercial loan. Now that interest rates are higher, banks still want to lend. I'm starting to see more commercial banks offer a 525. So it's that same 5-year note, but it's on a 25-year amortization schedule. So the amortization schedule longer, So it drops that monthly payment. So your client is not gonna make nearly as much if we go back to how we look at the cash flow and the principal reduction, all those things. They may actually be making, they probably are actually gonna get less positive impact to their net worth over that 5-year time frame because of that difference in amortization schedule. So they just gotta be aware of that, but I see a lot of people going that route to make the cash work and then plan on refinancing out of that once rates come back down.
Can I comment on that on first time investors?
Mhm.
If you have a first time investor that you don't think is super financially savvy, I don't think that commercial like 5-year loans, like they don't understand. They think 20 years amortized, like, oh, I've got for 20 years, and 5 years literally goes by and we die. Now on the marketing side, it's an amazing opportunity after 3 years to call them and be like, hey, you know, Misty, remember you guys bought that now 2 years, remember, okay, let me check, you know, you gotta check in on and wanna buy some more. So it's a great marketing tool, but I do have some investors that have purchased over the years, they're more of what I call, you know, young couple with a couple of kids, they watch HGTV, thought it was great to buy something, and they get a good tenant, and it's literally out of spent on money. And then 5 years rolls around, and they are sitting there scrambling. The rates went up to 8, and they had 4, and they're at cards. So it's got pros and cons, so I think you just get to know your investor, but I think sometimes that traditional route can be better, even if it costs more.
Yeah, absolutely. And that's, being more experienced to or friendly to that experienced investor. I typically push people, because like I said, I help people with find the right path. And I want to help them grow their portfolio. It'll benefit me that's on my side of the table. It's just how I look at it. And typically they start off on secondary market for the first 2 years, because for the first 2 years, their tax returns don't matter. We can take the lease amounts from the properties. We can use that to offset the payment. If you buy it, when they buy the next one, I can still use that lease income. I can use the next lease income. I can sell them another property, and all that's fine and dandy until they get to 2 years of being a landlord. Now we have to go off of tax return and what they actually pay taxes on as income. And that's a completely different story. So instead of them making $6,000 a year here and $6,000 a year there, they're now losing $20,000 a year. And so typically I start people, Fannie Mae, Freddie Mac, what we do, first 2 years, help them grow 3, 4, 5, 6 properties. And then they're ready to go over that commercial side. They have that experience. They have all the benefits that come on that commercial side at their disposal.
So the BRRRR method, so the BRRRR method is what we should be like marketing to our sellers right now, because sellers don't want to sell, buyers can't afford to buy, just for like this. I'm thinking of like what us realtors should be doing over the next few months when it might be slow. So like we should be marketing to sellers, take a HELOC out, buy a house at a good deal right now, because you can get a decent deal on a $250,000 house right now. Deal, I say, whatever. But so that would be like a good marketing strategy for us realtors right now.
I think so. I think especially again yes, I think so. I have people doing it, and also on the investor side. There's so many investors that are looking at their chops, wanting to buy more deals, and their cash is tied up behind great rates. So they don't want to get rid of. Use these HELOC products, get the money out of those rentals, and take advantage of this downturn, or balance, whatever you want to call it, and maintain the lower interest rate. That deal's the same exact thing. Yeah.
And then you were saying, since you can't refinance every 6 months, you could only use the BRRRR method twice a year, correct?
That would be so a couple different things. So that's per the property. So if you were going to, I guess, yes, if you were going to use that. Buy it, wait 6 months, complete the refinance, buy the next one, and it was all done with that original block of money, and you were doing it secondary market through me and Misty, then yes, you would be able to recycle that money twice in a year. If you go commercial, those brakes are off, and you can do it in a month and 2 months. Now, right now, banks are being a little bit more, it's called de-risking. They're not as courageous as they were a couple years ago. And so they may have, I now see 18-month holds on like apartment refinances and all sorts of stuff that wasn't common a couple years ago. So it's not a guarantee that you won't have a seasoning requirement. I bring that up because if someone buys something at 18% interest rate because you told them they need a seasoning requirement, and then every bank they find has one, they have an issue. Matt and I are doing or help with one right now where it's a pretty hefty purchase. It's $3 million at 19% interest is what he's borrowing to make this deal work. They got denied everywhere and they came to me and I called a guy and we were able to get it done. But before they're closing on it, we are setting, it's like a $57,000 a month interest payment. It's ugly. And so before
Minimum of 60 days.
minimum of 60 days. And so before they close on that deal, we're getting them approved through a commercial bank that will do it.
So is
Sounds like
that
you
first
guys,
one you're doing?
60 days. It's non-QM, so they don't have the type of like regulations that we have.
Right, but we would have to do, you know, on a lot of commercial.
We are right now.
Three-year feedback, okay, is what I see on most, but I don't know, I have 5 years. Really watch your.
So again, I think like you're saying, people get so hung up on the interest rate and didn't you do a post on that?
Yeah,
Like it just was, yeah. Sorry, my attention span on social media probably shorter than other people's, but I think people just need, like that was a great example. If you can just get your people to sit down and go over the numbers with them. Don't worry about the interest rate. Obviously at 19%. I'm
Like that's
worried at 19%.
Yeah, that's a pretty intimidating scenario. If he's a savvy business guy, obviously he would be playing in that bracket and he understands the risk. But it was a scenario where if it works really well for Matt and it works really well for the client. It was a win-win. We don't benefit from it, but we were able to find a solution. There's just 2 slides left. This next one I could get all the ins and outs of, but why I bring this up is this is how we find scenarios, how we find solutions is once you start to understand what's the tools in your tool belt, commercial really opens up. It is amazing what you can do on the commercial side of things once you have the clients and have built those relationships and have these relationships in place. So an easy one, you may not even think about it, ask for an IO period. If you're buying a rental property and you're going commercial financing right now, just ask, hey, can I have 6 months of interest only? Can I have 12 months of interest only? Probably will say yeah. So it's just a way that you can try to drive more cash right now when rates are high and rent is starting to decline. And you know, anything you can do to free up some cash flow now is beneficial.
You're fixing something up with this type of work.
It is, exactly. And so you use that as your stabilization period. If you need to fix up that property and it's going to sit vacant for 3 months, ask for interest only and just make it that much easier to get through that period of time. You can bundle your loans all into a single note. There's tons of advantages to that. We personally have something similar to that set up. I have a credit line against everything. And every year appreciation goes up and every year the notes go down and the credit line just grows. And they give me more firepower because it's based on the entire, which we'll talk about as a global debt position. Just things to think about. And like I said, you don't have to be an expert on all these things right now, but just understanding that they're out there. Cross collateralization. If you have a property and it's 50% loan to value and there's a 4% interest rate on it, and you're working with a commercial bank, they might just give you that 25% value that's left between the limit, which is 75%, and the 50% note you have as a down payment to buy something else and not even affect that original note, because what they're looking at is your global debt position. So if you have $1 million of real estate and it's half paid off, and then they give you the next $1 million of real estate with 0 down, you're really 1.5, or you're really 75% loan to value on the entire portfolio. Because you had $1 million worth of real estate, you owed $500,000. You bought another $1 million and put nothing down. Your global debt position is $1.5 million on $2 million of real estate. So once you start to understand how these mechanics work, it just becomes more and more easy to find solutions. The one that I love is like LTV to ARV. We did this all the time. And this was when there was pandemic COVID craziness. And I was a 27-year-old kid and they trusted me with so much gunpowder. But they would allow me to look at the future ARV then I would have to put down until my LTV got in range of the future ARV, which I know sounds like a bunch of jumble, but instead of putting down 25% on each property, I was only putting down 10%. So it allowed us to buy 2.5 times the amount of properties at once. So I went from being a kid that could afford to flip 1 or 2 houses at a time to a kid that could do 6 or 7 or 8 with the same amount of bandwidth. Just one opportunity opened up. So last thing I think is really important to know is you can't tax debt. So when you do these cash out refis and you get a 6-figure refi or you do this, none of that's taxed because you can't tax debt. So if you can shelter your income from paying taxes on and then pull out the debt that's tax free and then have people pay off the debt, you're living a very tax efficient life. So just deeper conversations to start thinking about. I thought about not writing the slide and I did it. And I don't even know if it's going to be valuable to you guys, but especially when I'm trying to talk to because like me personally, I look for Henrys, high earners, not rich yet, right? So the people that are making a lot of money and they're looking for people to help them grow their portfolio. And I have their best interest in mind, but like that is my perfect kind of buyer when I'm having advice. I want to help that person get to 10, get to 20, get to 30. If I can help them save money in their taxes, I'm helping them unlock more money to spend, more houses to buy. And so a couple of things to think about when you're buying a rental is that CapEx, those kitchen remodels, those roofs, everything like that. You're going to be capped at $3,000 per year of a loss. So you could put $30,000 into fixing up a rental and it's stuck at $3,000 a year of a write-off over 10 years. And so you're not getting necessarily a good return on the money you're spending from a tax efficient perspective. Why that is because most CPAs by standard do something called, straight line depreciation, where they're taking your depreciation schedule over 27.5 years, you deduct 3.6% every single year, and you get that, plus you get your $3,000 per property. And if you're putting $30,000, $40,000, $50,000 in a property, you're leaving a ton of potential write-off. If I could write you off $40,000 right now, or you can write off $3,000 for the next 13 years, let's write off $40,000 right now. How you do that, and I am not a CPA, I will tell you this has changed my life, is accelerated depreciation using cost segregation analysis. You pay a professional, they look at that rental property, they take it from 27 years of a depreciation schedule, typically 1, as much as 5, it varies. But essentially they take all that depreciation and slam it into 1 year. And so it hits your bottom line as a huge write-off. And it allows you to supersede that $3,000 a year.
Is there any recourse though if you sell it in that period?
Just like with your vehicle deduction, you buy it's over 6,000 pounds, you buy a Yukon, you buy a new one next year, you didn't get 2 deductions, right? They amortize it. It's a good question. It's the exact same thing. But what it gets really interesting, and if you stay till the end, this is really incredible, is if you make money through the transacting of buying and selling real estate that you own or are a realtor. So if you are a house flipper or a realtor, or you have a doctor that can afford to buy 2 or 3 flips a year, this will change their life, this right here. So if they have a business that makes money through the transacting of real estate, these passive losses, which is what this is considered, that $3,000 a year when they cap it, it's because rental income is considered passive income. And so it has different rules than active income. But as soon as you're a realtor or a house flipper, this rental income becomes your active income. Active income is treated like any other business that can lose hundreds of thousands of dollars. You own a pizzeria and it loses $200,000, that $200K flows over to your personal return. Your rental portfolio with straight line depreciation of $3,000 a year, it does not flow over. If you lost $200,000, it would just slowly be on that 27-year schedule. You would slowly get that benefit. So if you're in a position like a doctor, maybe his wife becomes a realtor, where she transacts from real estate, he's able to go buy property. If you have a $200,000 house,
This is a $30,000 deduction when we talk about straight line. And so now he just went from making $300,000 a year to 270. He buys 3 or 4 properties that year. He goes from making 300K on paper to 150K on paper. You start tackling all the other losses other businesses can own. It's called loss carryover. It's enormously powerful. So I got 100% refund for 2022. I won't pay taxes until 2025, as long as I can keep buying property. And so once you figure on my W-2, and that's, we lend, she sells real estate, we flip real estate, we have rentals, we have other things. There's so much loss that can be generated from cost segregation analysis, getting out of straight line depreciation. It is enough to wipe all of that hundreds of thousands of dollars negative to put us what they call a loss carryover. So now I'm tax exempt, which allows me to buy more real estate with just the money I'm not giving to the government, which allows me to buy more deductions because I keep buying real estate, which furthers how long I can go without paying taxes. So this is
This is good for investors.
This is good for investors. If you want to get your doctor friend to buy 20 properties, find someone that has a conversation about this because it'll change them. Doesn't affect like the new investor much, but once you start talking to people that have enough money where tax sheltering becomes more important, because if I can save you $100,000 in money today, it's so much more important to you than that 5% number, right? Like who cares about this if you can save them 200 grand, 100 grand now? So that's the conversations I have that get people into the game of buying real estate.
How much does guaranteed rate do any of this kind of lending?
We do. I appreciate the shout out. We would do primarily your new investors will have the best experience with like a guaranteed rate. We do HELOCs that help experienced investors unlock that equity. We do have a lot of products, but there are things that we went over today that we don't do. But I will help guide your clients to them. So if it's if the shoe fits on my foot, I wear it. And if it doesn't, I help them put it on the right foot.
Thank you, guys.
Guys, thank you.